All right, and we are back with another episode of the Real Estate Investing Q&A Show. This is episode number 8. Thanks again for tuning in. On this week's episode, picked out another 3 questions from Instagram, so I'm going to wrap through them real quick. But just a quick little update. Not too much has been going on that's been different. Finally banged out the refinance we've been working on today. Finally, it's taken like 2 weeks to finally get to a closing date. Columbus, we're probably about 75-85% raised. It's looking like we got one deal we're going to sell. Not really sure yet. We got a really good offer. Probably going to go under contract, so super pumped about that. And we also got another deal accepted, just working on the contract negotiations now to get that into PSA and start due diligence. So if you took a look at our Columbus deal and you liked it, or even if you didn't, this one's a little bit different. Not as much of a heavy lift, so pretty interesting. And it's something you want to take a look at, learn more about. Please feel free to reach out. My info is in the description below, but it's also chris@tororep.com, or you can hit me up on LinkedIn, Chris Grenzig. You can hit me up on Instagram at GrenzigCRE, Facebook if you really want, Chris Grenzig. But yeah, that's how you can reach out. So I'm probably going to be out and about pretty soon for due diligence on that. So hopefully we'll get some good stuff going. I really want to get some more video than we did last time. We did a little mashup of our Indianapolis-Columbus trip not too long ago. I just kind of did some shit there, but hopefully we'll have some cool stuff from that trip. And that's pretty much it. Oh, we spent about 4 hours the other day buying cabinets for our office. That was a clusterfuck. But yeah, the office is coming along good. They said hopefully by the end of the month we'll be in there. So keep an eye out. Could be a little bit of a different setup in the next couple weeks, especially for the podcast stuff. Oh, podcast. Real estate investing experience is going to be coming out soon. We've got 2 interviews this week, 2 interviews the next week, 2 interviews the next week. So we'll have about 8, 9, 10 lined up. We're going to get them up and rolling. If you want to get an email, go to the REIEXP.com, click on podcast, and enter your email address and stuff like that. I will be posting everywhere. We're thinking about doing a little giveaway, but if you want to get an email blast with everything going, sign up there and you'll get it first. So super excited to get that going, and just get more content and shit out for you guys. So with that being said, going to jump right into it with the first question. A little bit long, so going to cut it. I am a young investor myself with 7 doors in the Midwest and looking to rapidly expand this year. I was recently reading your blog post on Medium, and it made me wonder, how did you meet John Cohen and network your way over to the more institutional side of the game? I had an internship in commercial real estate and currently work in corporate finance, but I would like to get back to working daily in my passion while growing my own portfolio on the side, much like yourself. Did you already know John, or could you speak to what that transition was like? Thanks. So I've already done a really long video about this, but I'll speak to it a little bit more, and I'll speak some more on transitioning into it. So the way John and I met and how I got involved was, at first I had been trying to flip in Long Island, New York, and really failed for several months. And while we were doing that, just ended up trying to transition over into buying tax deeds at auction in Philadelphia. And the way we got introduced to that was we lent money to John's cousin, and through his cousin, we met John. We were just sitting down and telling him kind of our struggles and things we were doing and what we wanted to do, because at the time we were looking for flips, and he introduced us to buying the tax deed properties in Philadelphia, and we decided to give that a try. It wasn't for us, wasn't right, so decided to come back and just kind of regroup, say thanks, but it's probably not going to work out. And from there, he was raising money for a little 8-unit property he was doing on the side. He had just started Toro in 2015. This was in 2016, and he was trying to raise money, brought it up to us, said, do you guys want to invest? We just started learning about multifamily and what that kind of space was and how it worked from an investment side and from the syndication model. And it was something we thought might be a really good fit, because you can be out of state, you can raise money from other people, you can buy bigger projects than your own capital can sustain. So we said, yes, we'll invest, but with the caveat of, hey, can you kind of tell us everything you know, or teach us everything you know, or not everything, but Can we pick your brain once a week, every other week, jump on a phone call, grab some coffee, things like that. So we did that, invested passively, and pretty quickly just started, realizing we had some really good synergies. We started doing a bunch of different meetups every month, and then in that same area, we decided we were going to go out and buy another 17 units. So instead of just investing passively, we did a joint venture with him. Raised about, I think, 450, 500 grand. We were going to buy it all cash, improve it, and then refinance and burn and try to pull out 90, 100%, 110% of the equity, whatever it was, I forget at the time, and continue to buy properties in this area. Unfortunately, what happened was we ran into some contractor problems, had a couple $1,000 stolen from us, so we sold off one of the properties for a small profit. The other ones we renovated, rented up, but we weren't able to get the loan that we thought we could get. As well, we weren't really getting the same level of property management we thought we were going to get. So for the next 2 years, give or take, 2.5 years, we own those properties all cash. We were not able to refinance. We cash flowed okay. It wasn't, anything phenomenal. It wasn't anything terrible, but it wasn't like we hoped. Luckily, due to our underwriting and being conservative, we did just sell the last 2 properties. We did make a small profit. Again, not nearly what we were hoping. We did file a lawsuit. Unfortunately, the contractor basically had nothing to his name, so it's going to be very hard to collect. So there is the possibility of getting more down the line, but it's not looking likely. So, we didn't lose any money. We actually made a little bit of money. It was super conservative being in cash, so, valuable lesson learned. But from there, we kept in touch, and I actually moved full-time over into Toro. I was really looking to quit my job at the time and moved over, and then we also partnered on an 82-unit deal in Jacksonville, Florida. But making the switch from, that kind of small on the side, I was involved in a little over 100 units, both passively and as a joint venture. I think we were like 107, so syndicated just under 100. It was definitely a big change going from that to the larger stuff, 5, 10, 20, 30, $40 million deals. There's a lot more moving parts, but the foundational stuff is all the same. You're still, dealing with tenants. You're still doing the underwriting. You're just looking at, longer rent roll, bigger numbers, longer timelines. Things take a little bit longer to, kind of work as you're going through business plans. So you're also dealing with larger competitors as well. The groups that are buying $5 million deals are significantly smaller than the groups that are buying $35 million deals. So all of a sudden we started having to compete with groups that were, had larger economies of scale, had more of a presence in markets. They had more units. They had more staff. They had probably more experience than definitely myself, but probably a little bit more than John and Don as well. Some, not all. Probably greater resources as well. A lot of these larger companies start off by owners with tens, if not hundreds of millions of dollars, and they're looking to place it for themselves. And it's like a quasi-family office / investment company. And definitely going into a more sophisticated role and competing with those groups on some of these deals was a large change. Making sure your underwriting is really solid and you're not giving too many concessions to be too conservative because you're not going to win deals. Having a really firm understanding of the market and the mechanics behind it, the economics, the demographics, things like that. So you had to be a little bit more up on what you knew than just buying the local property that should cash flow pretty well. More sophisticated, more knowledge was needed, more market knowledge was needed. So making that changeover was exciting, is still exciting, is very fun to work on. It's just different from a larger standpoint, and your competition, I would say, is some of the bigger stuff. With that, we'll go on to the second question. So I'm looking at a commercial multifamily 7 units in the Detroit area with a possible add on value or value add. Any tips before buying? So when I have people coming to me with deals and they want help looking at it or things to look for, it's very tough unless I know the area to give specific information. So if you have a property and you send me the address, I can do a couple little things, but for me to really tell you about the area, about the property, rent and things, it's not very easy for me to do unless I were to sit down and spend a lot of time. But any tips before buying is significantly easier for me to do because I can tell you what to look for, how to find them, things to consider when you're thinking about buying, especially on the smaller side. So, there's a laundry list of things, but just some of the biggest ones. If you're not going to manage a property yourself, property management is going to make or break any deal you buy, especially when you're buying multifamily rental properties. They are the ones making the day-to-day decisions. They're the ones finding the tenants, managing the tenants, keeping up with the maintenance, making sure rent and income gets collected, making sure all the bills get paid. Now, it's obviously your job to stay on top of them, but that is what they're doing. So if you have somebody that's not up to snuff, that isn't doing things you like, isn't keeping track of things well enough, that property is going to probably suffer. It also depends on what level of information you want. If you just want it to stay 100% occupied and, you're okay with, just lack of reporting or not understanding every single dollar that's going into it, probably easier to find. If you want a more sophisticated reporting, better financials, quicker turnaround times, those are going to be tougher to find. So before you buy a property in an area, find the manager that's going to manage it and find the manager that's going to manage that same type of property. The group that is managing 300 unit Class A stuff is not managing a single family 5-unit, 10-unit in the ghetto. So make sure you understand your property management. Make sure you have some backups as well. Some other things I would look for is tips on value add. It would be understanding how taxes are going to be reassessed. That's a huge one. Oftentimes when a property is transacted, there's a reassessment on taxes. So make sure you understand. And sometimes there's not. Sometimes it's every so many years. Did they just pay it? Is it coming up? So make sure you understand what is going to happen with those taxes, because that's probably your single largest expense on any property you own, not including the mortgage. Also understand, if you're going to go out and get debt, what debt options are available to you. Just because this property may qualify for 75% Freddie loan at a 4.5 rate doesn't mean that you qualify for that loan. You've got to have liquidity. You've got to have net worth. If it's a commercial loan, you've got to have certain standards that allow you to qualify for that loan. So speak to, different lenders or mortgage brokers or local community banks that have lent on these types of properties before, and have that conversation about, how big of a loan do you qualify. When you get a property, ask them to take a quick look and say, hey, what range do you think I can get on this? What types of debt options are available? Fixed rate, floating rate, bridge loan, stable loan, etc. Make sure you know that going into it. Some other things I would think of is, when you buy a deal, it's very easy to think about the things that could go well. You got to start thinking about the things that could go wrong. So make sure you stress test the deal with different add-ons and see if it still makes some money, or at what level do things go wrong that you don't lose any money. So I would look at, doubling your CapEx budget, or tripling, or increasing by 50%, depending upon what you think is conservative, right? Increase the, amount of money you have to spend. Drop occupancy. See how far you can drop occupancy until you're breaking even. We always look at our break-even occupancy. Look at what else? Look at the sale price. So what is your break-even sale price? Where do you make money? If it's on a commercial and multifamily property, make sure you look at the cap rates. If you're buying in a 6 cap market and a 6.2 breaks even, I would not buy that deal. It's either not enough value, it's more than likely just overpriced. So I would look at, where you think it is, drop it by 50 basis points. So if you think it's a 6 cap sale, look at it a 6.5, look at it a 7. And if it's, break even at a 10, look at it all the way up to that and see what your return is. so that way you know how safe or conservative you're being. If you have a floating rate loan, look at it as the rate trends higher. Look at it as it trends lower. If you're expecting 75% of purchase, while you're under contract and you're going to buy that property, rates can change, which will affect proceeds because you have to have a certain coverage ratio on the debt service. Oftentimes it's a 1.25 or a 1.3, but if all of a sudden rates go from, and I'm being extreme, 4 to 8, your coverage ratio on that same property is going to be the coverage ratio is going to stay the same, but you're going to need a much lower loan to get there. So your proceeds are going to get affected. So look at, how does the deal look at 75, at 65, at 50? Look at those different things and how much money you're going to need to go raise. So I would definitely stress test a deal before you buy it. Those are some of the big ones. As far as other tips, if you're raising money from investors, I would always, one, have the conversation today to raise money for 12 months from now. And I would also plan on raising double what you need. Because just because somebody commits to a deal or a potential deal in the future and they say they would put $50,000 in, when push comes to shove, a lot of times people don't do as much or do what they say they're going to do. Or oftentimes two things change. They may have kids in college now, or medical bills came in, or something broke. Or who knows? Tons of different things happen. So they may be in a different situation than they were 6 months ago, or they may have invested it somewhere else, or they may have thought they were selling a property and it didn't sell what they were selling for. A million different things could happen, but I would plan on raising double what you need if you're going to go out and raise money. But those are some of the big ones. So I could go on for 2 hours of thinking of stuff, but we're going to go on to the third question, the last question, and end it after that. Is there a difference from real estate private equity and real estate syndications? Also, when raising money, do investors look at education at all, or is it mainly track record and your models? Real estate private equity and real estate syndications are a little bit synonymous. They're, I believe, technically the same. I think syndications is a little bit more limited in that you're only buying your own deals and you're only raising money. I've heard people use real estate private equity as people who will raise money to also invest in somebody else's deal. So we may have private equity groups that will raise money from their investors, put it into a fund or some sort of entity, and then they'll invest with that into our deals. So they're also considered real estate private equity. We're considered real estate private equity, but those groups that are investing with us, I would not call syndication groups. I would also call syndication. So there is a little bit of layover, and maybe some people call them the same. Maybe some people won't. Some people may just say private equity is the person that raises money for someone else's deal. But when you're talking to people, they might use things interchangeably. I would just get a firm understanding of what their business is, what they're looking to accomplish in their investments or their search for investments, and just figure out, what different avenues they have. Like, they may do a couple different things. So just find out, because oftentimes it can be a little bit confusing or some crossover. In terms of when you're raising money from investors, I think obviously all those things are important. Education, track record, models, all very important. I think each thing matters to different people. For us, John, Don, and I, none of us have our master's degree. If somebody really cared about having an MBA or an MS in real estate from a well-renowned school, they may not invest with us because we don't have that. That being said, I've never had an investor come up to us and say, hey, you don't have a master's degree, I'm not investing with you. So I think, at least in my experience, the education matters less to a certain extent. I would also say nobody's really asked what is my educational background now that I'm thinking about it, but they may have also looked ahead of time. So they may want to see a bachelor's or a high school degree or GED equivalent. But I've never had the direct question asked, but it's very possible that people look for that. I guess in our bios it is mentioned where we went to school, and what level of education we have. So I don't know how important that is. It's never been like a stumbling block for somebody, especially for a master's, PhD. That's never really come up. I think the more important for individual investors, it's tougher to speak for the bigger groups, but I would still say there's definitely a larger leaning towards track record and your underwriting. And I would say they're both pretty equally important. One being, just because you have certain past returns, it's not going to indicate future performance. If for whatever reason the past 6 years you've underwritten every deal to a 5.5 cap in major metros, you've probably hit your cap rate sale because of where the market is. But some groups may be significantly more conservative because they think in a year from now it's going to be a 6.5 cap market. If you underwrote to that 5.5 cap, you've been right, every single time, or in this case, let's just say every single time. Now, all of a sudden, if the market turns and does go to that 6.5, you're going to be wrong. So a group is going to equally look at your past deals as well as your underwriting. Just because, I've done so well in the past doesn't mean I'm all of a sudden going to do well in this, especially if it's a new area. You talk about the tax reassessment. It changes from area to area. If I underwrite to one way and it's, totally different in this new area, all my investors could get smoked if I don't understand how it's going to work or the mechanics behind it. So just because you have a track record doesn't mean they're just going to fund your investments. The other thing, too, is looking at, how not just the track record, but the way in which those deals actually performed versus your underwriting. Spoke about this on the last episode a little bit more on vetting syndicators and stuff like that, and it was touching upon that just because somebody returns a 30 IRR doesn't mean they really know what they're doing. Where I was talking about cap rates just now, if somebody bought every deal at a 6.5 cap and they underwrote to a 7 cap, and then all of a sudden the market's now a 5.5 cap, they could have done nothing and made some pretty good money. So just because you have a track record doesn't always necessarily mean the same thing as somebody else's track record. So it's definitely a blend between those two. I think those two are probably some of the more important things. I know as you start to get into the institutional and private equity space, they do care about some other things as well. A lot of groups want to see in-house property management. They want to know that you have control, or your people have control in the day-to-day operations. Some want to see, number of employees being at a certain level. They want to know that you have the resources to support their investment, and they also, future growth with your company. They don't want to just invest once and forget about it. They want to have somebody they can invest with for the next 2, 3, 5, 7, 20 years, who knows. So they want to know that you have the infrastructure to handle that. But I think your mom and pop probably cares about the track record that you have, because it shows that you've done this before and you've done well, or done what you said you're going to do. And they also probably care about your underwriting on this new deal. If all of a sudden you changed and you got significantly more aggressive, they may not feel as comfortable. If they feel margins have gotten too tight now, if they feel underwriting has gotten too aggressive, where in the past you were doing it differently, they may not be as confident going forward. So I would definitely say track record and your models or your underwriting matters more than your education, from what I've seen. Again, could be different in other people's experience. But that's it. That is my 3 questions for this week. If you did find this informative, educational, and you got something out of it, would really appreciate if you would like the video, subscribe to my channel. Means a lot. This is just something I'm trying out and figuring out as I go. If you have any questions or want any questions answered in the future, feel free to drop it in the comments. Hit me up on Instagram or on email, chris@tororep.com, Instagram @GrenzigCRE. Let me know your questions. Reach out. If I like it, I'll use it in the future. Trying to do more directed questions instead of finding stuff online. But that's it. That's my show. Thanks for watching.